The installment sale method of reporting gain is a great tool in the tax code, where a seller sells an asset and receives a promissory note in exchange. Then this allows you to spread gain out over the payments if any payments are to be received in a later tax year. Now, you can easily elect out of this treatment by simply reporting all gain on the income tax return where you initially report the sale. But if you mistakenly election out, that's not easily reversed. You must get permission from the IRS. In a recent private letter ruling, this was reinforced in that an amended return was not sufficient to reverse this inadvertent election out of the installment sale reporting of gain, even when the filing deadline for that tax year had not passed. Nonetheless, because the taxpayer formally submitted the request for a reversal of the election out to the IRS using the proper procedure, the relief was granted. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode 185, we're going to keep it a little more short and bring some brevity to the presentation and hopefully be under 10 minutes. But really, we're just looking at the fact that an amended return doesn't reverse an installment sale election. As always, this presentation is not intended to substitute for legal or tax advice. It is provided for educational purposes only. And if you'd like a copy of these slides, please email me at griffin.bridgers@gmail.com. On to the presentation. Now, in most cases, when you sell an asset, you might receive cash or property in exchange. And outside of some very narrow exceptions, the IRS taxes you on all of the gain on that sale in the year that the sale closes. There's one small exception to that we're going to look at today, and that's where the seller finances any part of the sale price by agreeing to receive installments of that sale price paid over time by the buyer. Now, if you have any installments that will be received after the year of sale, then each installment allows you to break it down to part return of basis, part gain, and part interest, because you have to have a minimum interest charge based on the federal applicable rate, or the AFR applicable federal rate for each of those installments, depending on the length of the term of the installment payments. Now, this treatment applies automatically unless you elect out. Now, the problem, as we're going to see, is that it's very easy to elect out, but it's very difficult to reverse that election out, even if it's mistaken. So, how do you elect out? Well, you can elect out of the installment sale treatment simply by reporting all gain on the income tax return in the year of sale. So, in other words, you're treating this sale of property in exchange for a promissory note as if there is a full recognition of gain, as you'd typically have if you sold the property for cash. And if you don't have an election out, if you want to use the installment sale treatment, you'd have to file Form 6252 in addition to your tax return. With those requirements, it makes it very easy to inadvertently or mistakenly elect out of installment sale treatment if you don't have sufficient communication, for example, with your CPA or your tax preparer. And what's worse is that if there is a mistake, if the election out is mistakenly made and the return is actually filed, then you have to go get a determination letter from the IRS to reverse it, even if you're still within the original tax year when you catch this and try to fix it. So, in other words, you can't just simply amend the return, even if you still have time to amend that return, even if the original filing deadline has not passed. And that's what happened in this recent private letter ruling. We had a situation where this wasn't necessarily conducive other than the switch in CPA, where you had buyer and seller who had both used the same CPA traditionally, but that CPA fell ill. So as part of a transaction where a seller had sold his business to a buyer in exchange for an installment note, the seller had to go get a new CPA. There's probably a miscommunication there, and the new CPA inadvertently elected out of the installment sale treatment. Seller didn't catch it, signed the return, filed it. Lo and behold, after the fact, they figure out, oh no, we inadvertently elected out. So what happened is seller and their CPA attempted to amend the return, but then discovered that that's not enough, that the regulations require you to get permission from the IRS. So Within the same tax year, they went and sought a ruling request based on the procedure required to reverse an election out. Luckily enough, the IRS granted this reversal because, one, there was no hindsight, two, the request was not motivated by tax avoidance, and three, while this wasn't a requirement, the IRS found that it was helpful that the ruling request was issued before the close of the tax year. Even though that's not a requirement, there's still a requirement for later years that you continue to report taxes as if the installment sale had actually been honored at the tax level. Usually, with a later year reporting and a later year catching of this error, you'd see that happen in, for example, where maybe you have a sale by a partnership and maybe individual partners have their own CPA and they're preparing their individual tax returns based on K1s. There's some sort of mismatch there. In this case, it was not necessarily represented that there was a pass-through entity. This was really just looking like an individual seller and individual buyer, but the change in CPA and the lack of communication did trigger this, but a helpful fact was that this was reported in the same tax year. But either way, there's really just some key takeaways that seem obvious on their face, but I think are helpful in any situation where you have a client with an installment sale. For one, if you're a CPA or tax preparer and your client sells an asset, I think it's a good idea to check to see if there was indeed an installment sale. Dig into the details of the sale and don't just assume that the purchase price was received in all cash. And if you're a seller, it's on you to let your CPA or tax preparer know about the installment sale itself. Now, as part of the deal points, you should have a written promissory note that complies with state law and that has interest equal to or greater than the AFR. And you should probably provide a copy of that promissory note to your CPA or tax preparer if you want to gain the advantage of this installment sale reporting of gain. Then finally, if you do catch a mistaken election out, it's too late. You can't fix it by simply amending the return, no matter when you catch the error. It could be immediately upon transmission of the return, but once you've done that, you've got to go through the letter ruling request procedure to reverse that mistaken or inadvertent election out. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.